How much would you be willing to spend on a tulip bouquet? A few bucks? $100? $1 million, perhaps? Most likely not. How much would you be willing to spend on this house? Or a share of a pet supply website? Tulips, real estate, and shares of Pets.com stock have all traded for substantially more than their actual value at various points throughout time. Each time, the price increased steadily until unexpectedly falling. Experts refer to this as a bubble. So what precisely happens when a bubble forms? To gain a better sense, let's start with the tulips. The Dutch Golden Age began in the 17th century in the Netherlands. Amsterdam was a significant port and economic hub by the 1630s. The Dutch import large quantities of spices from Asia in order to profit in Europe. As a result, Amsterdam was teeming with successful, wealthy merchants and businessmen who flaunted their wealth by residing in houses that were surrounded by flower gardens. The tulip was one bloom that was in particularly high demand. Trading ships from the east sailed to Europe carrying the tulip. Because tulips may take years to bloom, they were seen as an exotic flower that was extremely challenging to grow. A tulip-shattering virus epidemic in the 1630s enhanced the beauty of some blooms by coating the petals with multicolored, flame-like streaks. Because this type of tulip was more rare than a typical tulip, prices for these blooms began to soar, and along with them, tulip popularity. Tulip mania began not long after the tulip became a popular flower across the country. When there is an increase in price and a readiness to spend a lot of money on something with a much lower intrinsic value, it is called a manic episode. The dot-com craze of the 1990s is a more recent illustration of this. Equities in brand new, interesting websites were comparable to 17th century tulips. Everyone wants some. The price may increase the more individuals who want the tulip. A single tulip bulb once sold for more than 10 times the average yearly wage of a skilled craftsperson. The supply and demand of investors determine the price of stocks on the stock market. When it appears that a company will generate more money in the future, stock prices typically increase. The stock prices may then grow even further as a result of greater demand if investors purchase more of the shares. A feedback cycle where investors buy into the excitement and ultimately drive prices well over fundamental value, leading to a bubble, can arise from this. A collective understanding that the price of the stock, or a tulip, is far higher than its value is all that is required for a craze to end and for a bubble to burst. It was the same with both manias. Demand abruptly came to a stop. Prices were driven to unbelievable lows, and then boom. The market fell after the bubbles popped. Today, researchers put in a lot of time and effort to forecast what triggers bubbles and how to prevent them. The tulip mania is a good example of the fundamentals at play in a bubble and can help us comprehend more contemporary examples like the real estate bubble of the late 2000s. Booms and busts will still be a part of the economy's cycle. Treat yourself to a bouquet of tulips and take pleasure in the fact that you didn't pay an arm and a leg for them as we wait for the next craze to begin and the next bubble to collapse. Well, that's all for today's lesson on economic bubbles. Remember, if you see a bunch of people buying tulips for thousands of dollars, it's probably a good time to start hoarding your toilet paper. Just kidding. But seriously, keep an eye out for those bubbles and don't get caught up in the hype. Thanks for watching, and I'll see you in the next video where we'll discuss the economics of cat videos on YouTube. Lol, just kidding, but make sure to subscribe though.